Obviously, we spent a lot of time talking about the Genius Act and some of the implications. I wanted to circle back because we haven't really spent much time talking about stablecoin and the specific use cases we think are going to be in place. So I've asked Olivia Haller to join us to really dig in on what are the potential disruptions in the stablecoin space and what are some of the use cases that we need to be aware of and cognizant of. So Olivia, thanks for joining me.
Thanks, Tony. It's good to be here.
So what are the biggest use cases that you've seen that sort of seem to resonate?
Yeah, so I know we've talked about it a little bit and it's been in the news a lot. And truthfully, the use cases for stablecoin, they're a little touch and go. We're going to kind of have to wait and see. But as of right now, the top three are the cross-border payments. So it'd be really convenient for someone here to send money across border, obviously.
Sure.
Then another example of a potentially compelling use case is in other countries where they're looking for a more stable use of currency. And then lastly, the smart contracts and the idea that you can kind of have that programmable money and you can send for a service instantly, fast, digital. But those are the kind of top three-ish consumer use cases as of right now.
Yeah, I think for us as domestic financial institutions, for the most part, the smart contract's the one that probably has the biggest potential to be disruptive because it automates some of the things that we've done historically as bankers, as intermediaries in those things. And if those things can be programmed into a smart contract and a stable coin in that scenario, right, that's potential fee income or other income that could be disruptive for us.
Right. And that kind of leads into a question for you, but what do you think is kind of a big takeaway from that? Like something that could potentially disrupt the financial industry?
Yeah, I mean, I think for, domestic financial institutions, the biggest thing I'm concerned about is actually deposit disruption. So the ABA and Bank Policy Institute and a bunch of folks have come out and asked Congress to sort of update the Genius Act because they did put a criteria in there that said, as a stablecoin issuer, you can't pay interest, which was to protect bank deposits, candidly. But there's nothing in there about the facilitators. So Coinbase doesn't issue stablecoins, but they are partnered with Circle. And there's a revenue share model there by which Coinbase pays interest, or they call it rewards. And so there's the risk that the 4% yield that you earn on a stable coin is money that you move to a Coinbase account instead of your deposit account. And so, we've already seen a couple $1 trillion move as rates have gone up from banks to money market accounts. This is another potential risk in that space.
Gotcha.